Reinsurance is insurance for insurers, helping them manage risk by transferring part of their portfolio to a reinsurer. This stabilizes their financial position and frees up capital for more underwriting. The two main types are facultative and treaty. Facultative, purchased for individual risks. Treaty, covers an entire portfolio. Proportional, reinsurer shares premiums and losses based on a percentage. Non-proportional, reinsurer covers losses exceeding a certain threshold. Proportional, premiums and losses are shared. Non-proportional, reinsurer covers losses above a defined retention level. In a quota share, the cedant and reinsurer share premiums and losses in a fixed ratio. It's simple but less flexible, as all risks are treated the same regardless of size or nature. This non-proportional reinsurance covers losses exceeding a specific retention. It's commonly used for catastrophic events or large individual claims, helping insurers cap their exposure to severe losses. Surplus share reinsurance allows insurers to retain risks up to a defined amount and cede anything above it. It provides flexibility in managing risks of varying sizes. Stop-loss reinsurance protects the insurer against aggregate losses during a given period, often on a portfolio basis. Coverage kicks in once total losses exceed a percentage of the premiums earned. Retention is the amount of risk an insurer retains before reinsurance kicks in, while limits refer to the maximum amount the reinsurer will pay. These determine the cedant's exposure and the protection provided by reinsurance. Reinsurance strengthens solvency by transferring large risks, improving financial stability, and freeing up capital. This allows insurers to meet regulatory requirements and expand their underwriting capacity. Catastrophe reinsurance protects insurers from large-scale events like natural disasters. These are typically excess of loss contracts, offering protection once losses exceed a specific threshold. Key clauses in reinsurance contracts include claims handling, determines claim management responsibilities. Follow the fortunes, reinsurer follows cedant's underwriting and claims decisions. Reinstatement, specifies whether coverage limits are restored after a claim. Reinsurance premiums are based on expected losses, risk transfer levels, and cedant retention. Proportional contracts share original premiums, while non-proportional premiums depend on retention and exposure. Commissions are paid by reinsurers to cedants to compensate for acquisition and administration costs. Types include flat, sliding scale, and profit commissions. Reinsurance pools aggregate risks among multiple insurers or reinsurers, used for high-risk industries like nuclear or aviation. They spread the risk across participants to make it manageable. Reinsurance is regulated to ensure financial stability and consumer protection. Frameworks like Solvency II in the EU or risk-based capital in the US require insurers to maintain adequate capital in relation to risk.